Welcome to Mind Your Money. I'm Allie Canal, and this is Yahoo Finance's flagship personal finance show. Think of this as your financial toolbox. For the next 30 minutes, we'll give you the latest money news, cut through the jargon, and tap into expert advice, all designed to help you take control and build a stronger, healthier financial future. On today's show, a guide to online shopping after a tariff exemption on packages under $800 ends. We bring you expert advice. And 2 tax perks to take advantage of before the rebates end later this year. Plus, self-driving cars aren't just science fiction anymore. We'll discuss how autonomous vehicles could reshape how much you pay for auto insurance. The de minimis exemption, which allowed packages worth less than $800 to enter the U.S. without paying import taxes, is no more. It was first put in place back in 1938 under Section 321 of the Tariff Act. This was designed to save the government time and money on small shipments. Over the years, Congress raised the threshold multiple times, eventually landing at $800. And as online shopping took off, the number of de minimis packages did as well, rising from 153 million in 2015 to 1.4 billion in 2024. Now, with steep tariffs in place, several carriers say they will no longer ship packages to the U.S., and consumers could face higher prices for goods or even a tariff bill. Here with a breakdown of what this means for U.S. shoppers is Esther Fung, reporter at the Wall Street Journal. So Esther, thanks for being here. Let's start with the changes that online shoppers can expect to see now that the de minimis exemption is gone.
Right. Thank you for having me. Online shoppers should be expected to see higher prices for their purchases from abroad. They might see an additional tariff bill at checkout, or they might even receive a tariff bill from the carrier, FedEx, UPS, or DHL.
And how much higher, Esther, could these prices go on those everyday items that people buy online?
Yes, these prices could rise by 10% to more than 50%. So it is quite a sizable price increase. And for some consumers, they might feel that this is not worth purchasing online anymore. They might have to reconsider where they purchase the goods.
You mentioned that tariff bill. How would that work? And is that a likely event for consumers?
Right. So they might receive a surprise tariff bill if the seller does not include the tariff bill in the price of the goods itself. And this could be quite tricky and really, really annoying for the consumer. This is not a good customer experience, and many merchants have told me they're trying to include the price of the tariff inside, all-inclusive in the price of the goods itself. Now, the seller could also opt to have the recipient pay the tariff bill, and what the recipient could see is a tariff bill that comes into their email saying, hey, you've got a package with us. Before you pick up the package, we need you to pay this tariff bill. And I've already received some comments from some readers saying that they've received this surprise tariff bill. They're really unhappy about it, and they're still asking questions. It is quite confusing because they've never been used to this type of treatment.
Oh, I would be so surprised if I had a surprise tariff bill. And what if they just don't pay this? Does that mean they don't receive their package?
Yes, it's a possibility. If you don't pay it, you may not receive the package. The package might go back to the seller. For some consumers, they feel that they've already paid they already paid for the goods. They will just pay the additional tariff. It's just not a good feeling because you feel that you're blindsided. And so for sellers, they should be communicating this additional tariff charges to their consumers in the checkout process, maybe not just in fine print, because some of these consumers are saying, we're not going to shop with this seller anymore.
And does this apply to all types of packages from overseas, including personal packages?
So this treatment is now for all e-commerce packages. For personal packages, say the ones that you get from your friends or family abroad, this is exempt. So your friends or family abroad could still send you a care package with items that are valued less than $100. That's still okay.
Interesting. So we mentioned that some carriers are pausing shipments to the U.S. because of this. What are companies telling you?
So some foreign post offices have said that they are pausing sending e-commerce packages to the U.S. And some businesses that have relied on post offices to send their e-commerce packages to U.S. customers, they're telling me that this is so complicated, that the cost is too high. We really need to look at our options. And so they have halted shipping or selling to U.S. consumers for now. Some of them are worried that they would lose their U.S. customers, and they are trying to resume shipments by October in time for peak shipping season.
Yeah, sounds very complicated for those businesses along with consumers. Esther, thank you for trying to make sense of this latest development. Appreciate it.
Thank you, Allie.
Well, time is running out to take advantage of 2 tax breaks that President Trump's One Big Beautiful Bill did away with. Joining me now is senior autos reporter Praz Subramanian and senior reporter Emma Ackerman. So Praz, let's start with you here. The electric vehicle tax credit coming to an end on September 30th. What is this tax credit and how can American consumers take advantage of this before that deadline?
So Biden's the act that instituted this tax credit, $7,500 per EV, was very popular amongst consumers buying EVs and also for automakers that provided a lot of sales for them. With the OBB, Trump now got rid of that, and it's going to expire on the 30th of September. But some new IRS guidelines mention that how completion of the sale does not mean delivery has to take place before the 30th. So you and I can make a deal with the dealership, buy the car, sign a contract, pay a deposit. But if we take delivery later, we can still get that tax credit. So that's a big kind of boon for buyers who may not find the inventory they want right now, might want to wait for a car to come in, but they want to get that order in place. So they can do that now, and it helps them get that tax credit, which is a big deal when you're buying an EV.
Are there specific kinds of EVs that consumers should consider if they're still trying to race and purchase something before that deadline?
Yeah, I kind of put together a list here about 3 EVs I think that could fit people's different budgets. So I would say in the under the $35,000 budget, the Chevy Equinox EV, which is around that price range, a very capable car, nice crossover size there, very utilitarian, not very fancy, but it gets the job done. At the mid-level, people might hate me for saying this, but the Tesla Model Y is still one of the best vehicles out there that you can buy as an EV. A ton of capability, great software integration, great software in the car, great mobile app integration, and of course that supercharger network, which is basically ubiquitous everywhere. And finally, at the luxury high end, the BMW iX, amazing car, newly restyled for 2025, great exterior, better interior functions, vast range, huge power. Around $90,000, so it's pretty expensive, but you can get a good lease rate and you get that tax credit. It will help out a lot.
Have you driven any of those?
I've driven all 3.
Yeah?
Yeah.
So is it $90K worth it?
If you're going to lease it, sure. $90K is a lot of money.
It is a lot of money.
Yeah, lease plus that tax credit.
Right, of course. I'm sure it was really hard putting together that list for us, considering your car expertise. But Emma, I want to turn to you because this isn't the only deadline that we're looking at. President Trump's legislation also ending tax breaks for some energy-efficient home upgrades. So tell us more there.
Yeah, so for years, homeowners have been able to benefit from tax credits for solar panels and heat pumps and other green energy upgrades. Those are set to sunset at the end of the year, December 31st, and you actually have to have these upgrades installed by that date to qualify for these credits. And this comes as energy prices are rising nationwide, so this is an advantage or something that consumers might want to take advantage of pretty quickly. So I'll start with solar panel tax credits because those are pretty sizable. So the average solar panel installation can easily cost upwards of $20,000. This tax credit that exists right now and is expiring at the end of the year covers about 30% of the cost. So the cost savings can be several $1,000s. But again, you want to get these solar panels on your roof installed by the end of the year. And I would imagine that there's sort of a mad dash for solar panel rooftop installation contractors. So you would want to try and contact some of these folks yesterday or as fast as possible. And one tax expert that I spoke to also noted when you're going through that contacting process, you're also going to want to make sure to ask about timeline. Like, can you actually get this installed by the end of the year and have the project completed and get me the paperwork so I can qualify for this credit? Then there's another credit for energy efficiency upgrades. So this also covers 30% of the cost of, say, like heat pump installation, or up to $2,000. And then 30% are up to $1,200 for weatherization, like insulation improvements, up to $600 for electrical panels, $600 for exterior windows, and even up to $150 for an energy efficiency audit, or basically just somebody to come into your home and tell you how you can save money on energy efficiency upgrades.
Interesting, and you'd have to think with the expiration of these tax credits that might deter folks from adopting some of those energy efficient upgrades. But Emma Praz, thank you so much, appreciate your time. And you can scan the QR code below for more information from Yahoo Finance's taxes page. Well, coming up, self-driving cars are no longer the stuff of science fiction, but a reality. We discuss what self-driving options will mean for your auto insurance bill. Stay tuned. The average cost of auto insurance in the U.S. tops $2,600 a year, according to Bankrate. One thing that could eventually bring those costs down: self-driving cars. The Insurance Information Institute says if autonomous technology cuts the number and severity of accidents, premiums will likely follow. Right now, driverless robotaxis operate in 5 U.S. cities, and many new vehicles already come with features like automatic emergency braking and lane centering assistance. Insurance does cover vehicles with partial automation, like Tesla's Autopilot, while robotaxis fall under commercial insurance. But there still aren't any fully autonomous cars available to consumers, and experts say it could take decades before most vehicles on the road are driverless. In fact, only about 4% of new personal cars sold by 2035 are expected to be autonomous. Research backs up the safety case. The Insurance Institute for Highway Safety finds that automatic emergency braking reduces rear-end crashes by nearly 50%. Fewer severe accidents mean fewer costly claims. But the IIHS also warns that partially automated systems combining adaptive cruise control with lane centering for hands-free driving haven't yet delivered clear safety benefits and raise concerns about drivers over-relying on them. That said, progress is happening. Waymo reports its robotaxis had 78% fewer injury crashes and 79% fewer airbag deployment crashes than the average human driver in the same cities. Goldman Sachs analysts call those numbers encouraging, projecting commercial insurance costs for robotaxis could drop from 50 cents a mile today to about 23 cents by 2040. And you can scan the QR code below to learn more about self-driving and insurance. So with safety features advancing and robotaxis already on the roads in several cities, what does all of this mean for the future of your insurance bill and the timeline for real change? Joining me now is Michel Leonard, Insurance Information Institute Chief Economist. So Michel, everyday drivers are worried about rising premiums. Beyond some of that long-term automation, what's the near-term outlook here for auto insurance costs?
Well, the first thing to know, hi, Allie, by the way, it's nice to be here. Thanks for having me. The first thing to know is that we've had multiple years of increases in personal auto insurance. And that was mostly driven by the rising costs, especially during the pandemic, of labor, and now with tariffs of parts as well. So that's been how we got here. Now, if we're looking forward, those multiple year after year increases are expected to stabilize. So that's the first good news, that in terms of where we've come from, consumers, homeowners, households should not expect to continue to have the same multi-year increases.
Now, consumers, many of them out there, don't trust self-driving tech yet. So could that lack of adoption force these premiums to go higher?
Well, that's a very good point. The issue with self-driving and assisted driving is that we're all learning about it. I took my car driving up to Canada, and it was new, and I was waiting for it. I just got a new car, and I'm still not comfortable with it. So indeed, what our sister organization, for example, IHS, has determined is that a lot of these cases, one can be distracted, and they can cause accident. But Allie, we need to think about once we've gotten through this learning period, we're going to be indeed in that much safer environment. And those statistics that you've mentioned in terms of reduction of accidents, collisions, and so forth are going to start kicking in.
So let's talk about those types of accidents. What categories of accidents could nearly disappear if we do see real improvements on that side of autonomous tech driving?
Well, regretfully, I don't think we're talking about categories entirely disappearing. What we're going to be seeing, though, is a shift of some of these collisions and so forth. Not only will there be a reduction, but they're going to shift from personal lines to commercial lines. You know, Allie, these fully automated vehicles are going to be the private jets of the auto industry, and regular consumers, households, won't necessarily be able to afford them, at least for the foreseeable future. So what, again, we're seeing is that the way personal policy holders would benefit is that a lot of those claims, collision, are going to move to the commercial side.
And would premiums drop right away, or would we need years and years of accident data in order to factor into the costs that consumers pay?
Well, you know, our premium and our ability to change those premium is highly regulated, and that's a good thing. And they're regulated at the state level. So the first thing to say is that it's going to vary depending on the state, and the regulators in those states comfort with the data. We need more data. You were mentioning that fully automated vehicles are available in different cities. I drove a Waymo car recently in Arizona, and it was quite an experience, I have to say. I definitely wasn't ready for that. But we need to demonstrate, as you're pointing out, Allie, as you're discussing, Allie, multi-year trends in that regard. And that is what it is. It's going to take a little while before we get to that point.
Yeah, I've yet to drive in a Waymo or any other self-driving vehicle, but I am curious to see what that experience would be like. But I have been thinking, if you do have an accident, who ultimately pays for that? Is it the driver? Is it the software? Where does that liability fall?
Well, the first thing that your audience must know is that it's not the passenger. So they don't have to worry about getting into one of those cars. It will be on most likely a commercial policy, and it will be the owner of the car, the entity, the corporate probably entity that owns the cars that will be responsible for that.
And how about on the legislation side? What are regulators thinking, and have there been any movements on that in DC?
Well, remember, we're regulated at the state level. Of course, we work closely with federal regulators, but our as opposed to banks, for example, we're regulated at the state level, and regulators are really partners in this. You know, many years ago when these concepts were first discussed, insurance could have said, hey, we're not comfortable with that at all, even though the data said there are improvements, and regulators could have been very uncomfortable with it. And I think what we've seen is a partnership between carriers, insurers, and regulators to make sure that prudently we're able to explore these opportunities. And what's key here is that insurance, working again in tandem with its regulators, are very supportive of innovation. And that's something we've always been in the insurance industry.
All right, Michel, we'll see what the future holds. Thank you so much.
Indeed. Take care, Allie.
It's time now for our weekly segment, Ask Yahoo Finance Anything, where we answer your viewer questions on air. This week we have Bob Powell, the host of the Decoding Retirement podcast. And Bob, you have questions this week ranging from advice on tax advantage accounts to insurance. So let's dive right in. Question number one. This viewer says, I'm often told to consider a Roth IRA based on my current and projected tax bracket. Is that the correct way to go about it?
Yeah, so Allie, when deciding on Roth conversions, most people just look at their current tax bracket, but that's not the whole story, and it could cost you thousands. So here's what they miss. A Roth conversion is essentially prepaying taxes today to avoid them later. So the key question is whether you'll pay less in taxes now or in retirement. Sounds simple, right? But your tax bracket doesn't tell you your true marginal rate, and that's because when you're converting from to a Roth, it can trigger hidden tax effects. So, for example, the extra income from a Roth IRA conversion might make more of your Social Security benefits taxable. And that means that you're not just paying tax on the conversion amount, but also on the additional Social Security benefit as well. So the solution is this, Allie: calculate your true marginal tax rate by looking at the total tax impact, not just your bracket. And this will allow you to time your conversions strategically.
And question number 2, someone else asks, should I consider a Coverdell education savings account? And Bob, I've actually never heard this. So can you first break down what this account is and then who it might be good for?
Sure. It's a type of education savings account. Most people are familiar with a 529 plan, but no one ever talks about a Coverdell or what's sometimes called a ESA. So here's why you should consider it, Allie. You can contribute, it's a small amount, $2,000 per year for each child under 18. Or if they have special needs, you can contribute beyond age 18. The money grows tax-free. Withdrawals are completely tax-free when used for qualified education expenses, just like a 529 plan. There are some income limits, but high earners can work around it by having someone else make contributions. And the thing that makes ESA special is that the definition of qualified education expenses is incredibly broad. It includes college tuition, room and board, books, computers, internet access. And the kicker here is you can use ESA funds for pre-kindergarten to 12 expenses too, and private schools, tuition, tutoring, even special needs services qualify. So you might say, well, $2,000 is not a lot to contribute, but every tax break counts when you're saving for education. And you can fund both. You can fund your 529 plan and ESA for the same child. So my advice would be to talk to a competent, qualified financial advisor and about your education funding strategy before you start contributing to either the 529 or the ESA account.
Some great context there. Now, I want to bring in some insurance-related questions. One viewer asks, should I consider disability insurance beyond what my employer offers me?
Yeah, so this is an interesting question, too, because most people think that their most valuable asset is their house or their 401k portfolio, but they would be wrong. Especially when you're working, your human capital is your largest asset. And your ability to earn income is what you need to protect. And you protect it mostly with disability insurance. And most people think that they can get disability insurance through their employer, which they can. But the problem is that there's some limits to what it protects when you have an employer-provided plan. It doesn't, for instance, it covers your basic salary, but it might not cover your bonuses or your commissions. And often it caps benefits well below, especially what high earners actually need. Plus, those benefits are taxable, and that reduces their real value even further. So I would recommend that you look for an supplemental individual coverage, review your actual coverage needs, understand policy terms like own occupation versus any occupation. And again, talk to a competent financial advisor about what's your best policy, given that you may have an employer-provided plan, but it doesn't cover everything that you might need should you become disabled and unable to work.
All right, final question here for you, Bob. I have an ACA Bronze Health Insurance Plan. Is it true that starting in 2026, I'll be able to contribute to a health savings account? And ACA is in reference to the Affordable Care Act, right, Bob?
Yeah, Allie, this is a great big part of the One Big Beautiful Bill Act that was signed into law by President Trump in July. We've introduced sweeping changes to health savings accounts, or HSAs. So according to J.O., he's the author of Maximize Your Medicare. One of the most significant changes allows individuals who have either a bronze or a catastrophic health plan to establish HSAs for the first time. Previously, only those who had high deductible health plans through their employer could contribute to an HSA account. And the good news here is now that if you're in a bronze or catastrophic plan, you can now benefit from HSAs, which offer triple tax benefits. The money goes in tax-free, it grows tax-free, and it comes out tax-free when you use it for qualified medical expenses.
All right, Bob, great answers to those questions. Thanks so much. Appreciate it.
Thank you, Allie.
Well, that's it for Mind Your Money. Scan the QR code below to sign up for the Mind Your Money newsletter and stay tuned for Market Domination. That's coming up next.